literally a bit of everything. So we can kind of categorize it as you touched on, in terms of regulated and non-regulated. So the kind of straightforward way of that would be your kind of family moves versus your investment stuff. But that can be, literally anything. A lovely old lady or old gent downsizing because they're now widowed and their house is too big, they're property rich, cash poor, shed load of equity in their house, don't have any cash to buy a new one, so they utilize the equity to buy the new one before they sell their old one. Developer who's going out there identifying kind of places where new housing stock is required and maybe buying something that needs a bit of love and doing it, selling it on or letting it out. So cash flow purposes, the list goes on and on. I remember someone saying to me previously, if you drive down the street and there's a scaffolding on a house, there's a chance there's a bridging loan secured against it. I think is quite interesting way of looking at it. It can be a cash injection if someone's doing work to their own property and they need a bit of a cash injection. It can be, as I touched on, buying something to kind of do it up. I think the crux of it is that realistically, most high street lenders, i.e. mortgage lenders, traditional kind of mortgage lenders, don't actually like or want you doing much work to your house whilst you've got a mortgage. If you look through your mortgage conditions, if you've got a mortgage, say you can't do work to it, or certainly the bare minimum would be you need to contact us and get our consent before you do some work. Not many people kind of realize that and knock their house around, and because the reality is, do NatWest or Barclays come knocking on your door and check that you've not done anything? No, they don't. But that's not to say you shouldn't be doing it. I think giving it a lick of paint, obviously there's common sense there, but unfortunately we do see a lot of people who have done a lot of work to their property whilst they got a mortgage on there, and the danger there is that the level of work can actually decrease the value of the property, because before it gets better, it gets worse, i.e. you're knocking it about, you're gutting it in some instances, putting an extension on that's not wind and watertight. Then they go, actually, I'm struggling here. The value's gone down, my debt's gone up, and all of a sudden I need some help. And the first question is, have you told the mortgage provider about this? And more often than not, it's no. So, again, just solving problems, really. So, again, depending on the kind of driving force behind it, but taking that as an example, so that was a purchase abroad. They'd already paid a deposit, so we'd raised finance previously to so I guess that's a good example. Look, to be completely frank, we'd raised a deposit with another lender because they were slightly cheaper to buy a property abroad. Client had their property sold subject to contract and just needed that quick cash injection. Very similar to I was alluding to earlier, kind of property rich, cash poor, loads of equity, not a lot of cash. Unfortunately, then the buyer had pulled out. There was a bit of an issue with the chain, etc. And then we came to Greenfield because they were the kind of cheapest on the flexible side, if that makes sense. So you get what you pay for, don't you? I have a conversation probably once a week with a client where you'll say, you're not going to get the cheapest lender on the market and the most flexible lender in the market in the same deal. Otherwise, guess what? There would only be one bridging lender around. So our job, really in a nutshell, is finding out, which kind of answers your question in terms of what are the gains. Speaking to an advisor who actually does this, day in, day out, is finding, okay, well, do I go with the cheapest lender, but there's a deadline in place and maybe it's not going to happen in time? Do I go with the most flexible lender, but I'm probably going to pay more than I need to? So where on that line of, there's definitely anomalies, but generally speaking, it's a rate versus flexibility and speed exercise. That's not to say, you can't use, and this was a good example, and there's other cheap lenders out there as well, who are very fast as well. So I think there's 2 points there. Where do you place the client in terms of your advice, as far as, again, advice versus paying for flexibility or perceived flexibility? Because I think some cheaper lenders are a lot more flexible than perhaps people think they are. Flexibility in terms of, some lenders might have a maximum age and the client might be 6 months older than maximum age. Some lenders will say, look, it is what it is, no can do. Other lenders will show a little bit of flexibility. Some lenders will only lend in certain parts of the country. This might be slightly outside. might be the one we did was probably a touch over the maximum loan to value that a lender would usually do. But again, it was sold subject to, and the valuer confirmed it was, you know, a red hot property and all this kind of stuff. So it's basically, I guess, flexibility is probably more apt to say someone taking a common sense view on it of, if this was my money, would I do this? And yes, and then that's down to us as well as advisors to present a case which gives a lender an appetite to see your way of thinking and want to do the deal. So we quite frequently get, you know, lenders where we, cases where we approach a lender and they've probably spoken to someone else about the same case, and we've presented it slightly differently. And look, no doubt we've been on the other end of that as well, and someone else has presented it better. You know, that's the gig, but we like to think we kind of win more than we lose. But yeah, in terms of flexibility, I guess to sum it up, a bit of a common sense view. But what are the advantages of that? I guess when you lean more towards the cheaper lenders, you know, we do auction purchases with the cheapest lenders on the market, and some brokers would go, no way, they're never going to do that. They do, and we do, and it does happen. So that's down to you doing your job correctly and making sure that you know their processes. You're not dragging things out, you're preempting possible issues, and again, that just comes back to, you know, being a specialist in the area. And that's not to say, you know, we're no better as people or advisors than anyone else. We just choose to focus our attention on one part of the market and do it well, and not be a jack of all trades kind of thing. So that's one of the advantages. And I guess on the flip side of that, one of the pitfalls will be some brokers get very comfortable using certain lenders who are either very quick or certainly perceived as very quick. There's an argument it can be a bit lazy and just putting clients with lenders who are a bit more expensive than the client needs to pay because, oh, look, these guys are really flexible and quick. And whilst they might be, you know, there's ladies and gents at cheaper lenders who could also get the deal done. Maybe it's a bit more work for the broker, but I would argue that's your job, and you know, every penny counts. And I think if you look at using an auction purchase as an example, or I guess actually, yeah, let's talk about the deal we did together. So there was the deposit was up for it was a purchase in Spain. There was a hard deadline there, and we need to raise the rest of the money. Otherwise, that deposit was kind of gone to the wind. They'd made it fairly clear abroad that there was no flexibility there, and that was a kind of very hard deadline. And I think the key there then is on the broker's end, making sure that the client's aware that there needs to be a buy-in from the client day one, i.e. we need to pay the solicitors straight away to get work in. If there's a valuation, we need to pay the valuer straight away to get out there. You know, we can't be saying with one breath we need it done super quickly, and then with another breath saying, oh well, I want to pay this fee, and then I'll make sure the valuation's okay, then I'll get the solicitors moving, and then kind of doing it in bit part. There needs to be it's cliche, but there needs to be, you know, everyone pushing in the same direction, and a team effort. And it needs to be the broker being very transparent with what's the case is, warts and all, any kind of potential issues, we can knock them on the head early doors. And similarly from the lender, look, we need this done in X amount of time, all being well, can you do it? You know, have you got the capacity to do that? Because there are lenders out there who will get you in the door and say, yeah, of course we can do that. And then by the time you kind of wrap things up, obviously things crop up and there's, you know, certain stumbling blocks, but you look back and think there was never, you know, we were never going to do that in the right timescales. And that's what kind of gets my back up a little bit. So, you know, maximizing the advantages and minimizing the disadvantages. And unfortunately, sometimes the only way to do that is go with a broker who's been there and done that and learned their lessons and been around the block. And I think that's what we can certainly offer. You know, we're not Mr. and Mrs. Perfect as advisors, but, you know, we've done there and been there and done that. So, yeah, hopefully, you know, clients don't have to learn the hard way because we've already done that for them. Absolutely, yeah. And we've got a client who we do a fair bit of marketing with, I guess, who we've, as a kind of case study, we took her as a initial kind of investor. She'd done a little bit of kind of kitchen bathroom stuff, you know, just buying a kind of deceased estate, I guess, or just tired properties, needed a kitchen, bathroom, lick of paint, nothing mental. Had done a few of them. She had some cash there. We did a couple of fairly modest sized deals for her. She was kind of learning her trade as well in terms of where to buy, what her MO was, and the plan was always, I'm going to scale this and I'm going to end up doing monstrous deals and huge properties and all this kind of stuff. And it was actually really interesting because as the years have gone by, we've kind of just come up with the strategy of just doing more and more frequently, but more of the same rather than scaling it massively. Get to a point where we've done a couple of flips, or she's retained some or whatever, done a couple of deals, I guess is the point, made some money, and rather than I'm going to level this up now and do something huge, actually I'm just going to run 2 simultaneously, and then over time I'm actually just going to run 3 simultaneously and just doing more of the same, because I think there's always, once you again kind of become a specialist in a certain area, particularly on the investment side, I'm a very big believer of if it ain't broke, don't fix it kind of thing. She's making good money, gone from doing 1 a year to 3, 4, 5, 6 a year, whatever that number might be, and making really good money out of it now. So why scale it up, dip your toe into something you're perhaps not as experienced in? Lenders will take a view, because you've got a baseline level experience of doing some light refurb. You'll get some lenders then who will do some medium or heavy refurb, but you're not going to get the lenders who are offering A1 rates for people who've done a shed load of medium or heavy refurbs. You're going to get the lenders who will take a view that you've got a level of experience, but not quite really experienced in what this new proposal is. So it's just, they look at it as a stepping block. There are lenders who will do that, but you're going to pay a bit more for it. So then it becomes a question of, is it worth paying a little bit more to do something you don't really, let's be blunt, know what you're doing there, or do you stick to what you know and do more of it? So again, those are the kind of conversations. Some people have just got massive aspirations and want to level up and do that, and that's great. We can help them do that, but then our job is to explain that, look, you're going to pay a little bit more on the next one till you get a bit of experience. Then we can approach the lenders who are taking more of a risk by giving you better rates and making less of a return, but in the return from them, they're going to want you to have experience. So it's kind of following that journey from infancy all the way through, and 2 people's journeys might look very differently. One might stick like this lady does, of just doing more of the same and doing more of it, and someone else might, sky's the limit and move into different sectors. So again, it's not necessarily a one size fits all. There's a conversation to have, and our job is often talking to the client and relaying to them that the marketing you see online of lenders might do 75% loan to value and this might be their rate. Those things necessarily don't go together, and trying to explain that, and like it or not, it shouldn't happen, but sometimes clients are misquoted elsewhere by accident, you'd like to think, but try to talk clients into, this is probably what's happened here, and you should take a bit of a view on fact check things and that kind of stuff. So yeah, it's a kind of holistic service, if you like, as cliche as the word is. Yeah, probably a couple of points there, I guess. So in terms of it's definitely, as you touched on it, it's definitely getting more popular is probably the wrong word, but it might not be, but more people know about it, more people aren't scared of it. When I started, probably a little bit before that, about 10 years ago, in answer to your question. And I think, the regulations are obviously really helpful. Some people don't like it, as far as, you have to then do exams and your company has to be regulated, and there's obviously kind of red tape that comes along with that, and an administrative burden. But I think when it all boils down, it's good for the client. In terms of what's kind of changed, I think during COVID and the stamp duty, what's the word I'm looking for? Kind of incentive, where they were knocking stamp duty down for a period of time. So we actually had clients at that time where the stamp duty saving was actually more than the cost of the bridge. So everyday thing. But my point is, these clients for the first time probably in history were busting to take a bridging loan, where, you know, generally speaking, no one gets up in the morning and says, oh, you know what I want to do today is take a bridging loan, unless there's a problem to solve or an opportunity they can't do without someone else's money, I guess is the crux of it. So yeah, that was a good example, because the kind of product was then thrust into the limelight, and, you know, this is your kind of time to shine. And I think, you know, I was quite proud of the industry and as a whole there, because lenders could have taken that as an opportunity. Look, we're going to hike rates up, make hay whilst the sun shines, but they didn't do that and thought, you know, thankfully, let's treat these customers well, show them what we're about, and you'd like to think a lot of them had a good service and came back time and time again. So I think, yeah, it's going in the right direction. I think that there's certainly some of the misconceptions I think we kind of touched on earlier, actually, that you've got to go with a lender who is deemed as fast and flexible to have a lender who's fast and flexible. I think a massive misconception is some of the lenders and banks who are offering the cheapest rates are, computer says no. That's categorically not the case. As I say, we do auctions and stuff with some of the cheapest lenders out there, and, you know, there are deals where you just can't go with those lenders. You need someone who's a bit more expensive for various reasons, the level of works maybe, or the client profile, credit, and all this kind of stuff, or the area that you're doing it, experience. Again, there's a list as long as you're on, but I think the misconception is that you have to just, as soon as someone says, look, I need something done quickly, Mr. Client or Mrs. Client's on the phone, right, we're going to go to this lender because they're really, really quick. So I think that's quite a large misconception. And then probably on the client's end, just the actual cost is probably an obvious one. I guess the crux of it, again, is what I think you know, it might sound a bit obvious, but what are the client's alternatives? So if, let's take a residential transaction as an example, if you're buying a house, I'm buying your house, someone's buying my house, all of a sudden you decide you don't want to play ball anymore. All right, well, what are my options now? I either take some financing to facilitate this purchase, i.e. a bridging loan to repair the chain, or I don't, you know, I buy something else, or I wait for another buyer and hope that everyone's on board with waiting and that type of thing. So I guess, as you know, as straightforward sometimes as that might sound, what are the other options? And if it's a case of the cost is too much, then the cost is too much. If it's then an investment, sorry, and I guess just to touch on that, as you absolutely rightly said, your best bridging rates at the moment aren't a million miles off what a mortgage is. And I think what is massively important, and something, again, we kind of quite frequently have conversations with our client, you might have a mortgage at 2% a year. You look at your illustration, I bet you, I say £1 million, I haven't got £1 million, but you know, you're going to pay back double what you borrow. I think regardless of what your rate is, I think you have a look at your mortgage illustration, you'll pay back probably double what you borrow. Again, the illustration's assuming you don't remortgage for a better rate every 2 or 5 years or whatever that might be. But the point is, I think the misconceptions sometimes are just the headline rate, and that's probably not a misconception, but it's a misconception off the back of the rate of what that real cost is. So you look at your mortgage illustration, again, you might pay 2% a year, which at the moment would be pretty epic, wouldn't it? But you're going to pay that for, you know, 30 years. Whereas you might say to someone, all right, well, this bridge is going to cost you 9% a year, for argument's sake. So again, going back to the kind of simplicity of, all right, well, what are the other options? Realistically, if you want to raise finance because you want to repair this chain, because you want to buy this house, you've got a choice. Do it, don't do it. Fine. If you need to do something, i.e. there's a deadline of, you've won a property at auction, and believe it or not, some people get in touch and say, I've won a property at auction. I go, okay, what happened with your financing? Why is it falling through? Oh, well, actually, I haven't got any this crazy, but it does happen. But yeah, my point is, if you want to do something, then you've got a choice. You know, that cost is obviously more often than not the deciding factor. But even then, I want to buy a house to do a bit of a refurb and sell it on. Okay, 2 years ago I might have made 50 grand profit. Rates have gone up a bit. Now I might make 40 grand profit. But again, it's a do it or don't do it, make a bit less profit, or don't do it and make no profit. So, it's just how high do you value your time as far as doing something and making a profit off the back of it. That's a very good point in terms of the opportunity part of it. You might buy number one in the street, do a little bit of work, increase the value. You might make X amount of profit, which is okay, but when you take into account the cost of finance, it's a little bit tight. Generally speaking, costs will overrun, time will overrun, people under budget, and this kind of stuff. So those margins are getting squeezed. You might find another opportunity, number 10 in the same street, which for one reason or another needs a bit more work, or you get it for a lower price, a number of reasons. That profit margin is a lot larger. Therefore, even with a higher rate and a higher cost, even if costs overrun, labor and materials overrun, and you're probably under budgeting it, there's still a healthy profit there. So yeah. Cost in those two examples, because there's a larger profit margin in deal number 2, it makes more sense to do. So again, it's not necessarily just a one size fits all based on the numbers. It's a case of, all right, how much profit do you want to make? And if you're someone who's super experienced and does this all the time, that might be quite a bit. If you're fairly inexperienced and you're just looking to get your foot on the ladder, you're probably not going to make a fortune, but you're cutting your teeth and this type of thing. So again, then it's a case of, where do you draw the line between making a profit and kind of wasting your time for not a lot of money? And again, that the answer to that will vary to person to person. So yeah, I think in terms of the misconceptions on the cost front, it's definitely there. Again, it's a means to an end. I think it's solving a problem.
Yeah.
If you want to buy a house, and unless you've got £500,000 for your family to buy a house and live in there, you're going to need a mortgage. So then it's a case of, I need to do something. I'm going to go and find the best mortgage for me. Again, with a bridge, if it's something that you need to do, then the aim of the game then becomes, okay, let's find the most cost-effective way of doing this while still hitting any targets that are in place, i.e. deadlines and that type of thing. Versus if it's something that I want to do, an investment, there's more facets to it then. There's cost, there's building a relationship with a lender who you're probably going to want to go back to time and time again, rather than a residential piece, which is a bit more transactional. You're going to do a chain break, or you're going to downsize, and you're not going to do that again, I can't imagine. Whereas, yeah, when it's investment, building relationships and lenders who, going back to the flexibility thing, if you come into a bit of hot water, you overrun or a number of issues, are they going to work with you, or are they just going to say, time's up, can we have our money back, please? And again, that comes back to what we were saying earlier in terms of us as advisors, because clients don't know the answer to that. And it's our job to say, look, these ladies and gents are fairly similar price-wise to these ladies and gents, but we've had amazing experiences with these. They're really client-focused and are great on the back end because they value that relationship and they want you to come back time and time again. Whereas these ladies and gents, not so much. They're a business and you've signed the documents and you owe them the money and they want it back, which is fine. That it is what it is. But again, it's just putting you as the client into the picture of what the whole picture looks like, rather than just the numbers on the page, which sometimes can be the most difficult part of the role, particularly if a client speaking to other brokers or has spoken to other brokers or has got a relationship with other brokers. And some people can get a little bit blinkered of, they might have used a lender. I might speak to a lady or gent this afternoon who's used a lender I am probably reluctant to use, and they've used them half a dozen times, thinks they're brilliant. And I say, out of interest, how come you've used them so many times? Because they're really quick. And going back to our point earlier, well, I use lenders who are far cheaper than them and they're just as quick. So it's a number of them, and let's be blunt, they're not doing anything wrong. Again, you're signing the documents for a loan of 12 months, and if you don't repay them, they can take legal action against you. There's nothing on the paperwork to say we have to be really kind to you and be flexible and work with you. It's a legal transaction, it's a contract at the end of the day. So yeah, there's lenders out there, and there's definitely reason to use them, and we do use them in certain circumstances where, probably touching on, there's a need rather than a want, and there's a deadline and the risks of what that might look like, and that's fine. But I think there's definitely lenders, everyone knows who I'm talking about, where you go over term, they're going to slap you with some fees, they're not going to look very pretty, and that's what you're signing up for. But you're getting something good out of it the front end, so you're very much, it's give and take, you're getting what you pay for. Some other lenders will be a bit more, steady Eddie, rather than like this on the front end, very helpful, like this on the back end, very expensive. So we're back to the speed versus flexibility, and that's where we come in, as having been there and done that and seen it firsthand. But there's lenders out there, as I say, I'm not trying to drag anyone, because there's the advantages of using a good broker and a good lender is you're getting exactly what you need, and it's the broker's job to identify what it is you actually want. Because sometimes a client will say to you, look, I need X amount, and I need it really quickly. And I go, okay, well, A, how quick is quick? And B, why do you need it that quickly? Oh, because the vendor wants it really quickly. All right, well, does that mean I'm just going to bang you with a lender who's going to be really quick but more expensive? Or most likely, are we going to take a bit of time to identify, has this been dragging along for 6 months and there genuinely is a real need to get this done in a week? Or actually, if we speak to the agent, offer to speak to whoever, the vendor, solicitors, whoever needs to be kept in the picture. Reality is everyone's on the same page as far as the vendor wants it sold, agent wants it sold, solicitors want it done, we want it done, client wants it bought. So everyone's pushing in the same direction. It's about keeping everyone in the loop. And if we can do that, still do it quickly, maybe not in a couple of days, but you're paying far too much for that service, when realistically 2 weeks might be sufficient, whereas 2 days is unnecessary. You're going to save yourself, depending on the loan size, thousands, tens of thousands sometimes, and probably get a much better service. It's the broker's job then to keep everyone in the picture. And realistically, what's the vendor going to do? Put it back on the market, go back to square one? Obviously they can if they want to, but we find more often than not, people who are fairly reasonable and haven't already been dragged along for ages, keep them in the loop and explain everyone's on the same team, and you don't have that many issues.